Hello. By now you're probably thinking, gee, doesn't Alan ever change his shirt? Actually, this is the fourth video I've recorded today. Okay, so the purpose of this video is to cover Chapter 4's homework exercises. I will put the solutions into a separate video for the appendix Chapter 4-A. Okay, so here I'll just cover the assigned homework from Chapter 4 proper. It is exercises, problems, whatever you want to call them, 1, 2, 5, 6, 7, and 8, okay? Let's go take a look at these together and then solve them. Okay, number one, this one's pretty straightforward. You can pull this right out of the text, okay? According to GAAP, the equity section of a corporation is going to say something like this: common stock, par value, we all discussed what par value was, 4 million shares authorized, 3.8 million shares issued, and 3,050,000 shares outstanding. My question is, how many shares of common stock is the company holding as treasury stock? Treasury stock is defined, as I mentioned to you, and as your financial accounting professor mentioned to you, as any shares that the company buys off the street themselves. There's nothing stopping a company, just like you would go out and buy stock of GE, there's nothing stopping GE from going out and buying its own shares. The only problem is they have to pay the same price as any other shareholder, number one. Number two, GE will not receive any dividends on those treasury shares, and they do not get a vote, okay? Those are important restrictions. Why does a company do that? If you want to know why a company would buy its own stock, there are several reasons, and they're all very good strategic reasons. If you want to know, write to me. I'll be happy to expand on that in an email to you. It's kind of interesting, really. So the question is, how many shares is the company holding as treasury stock? Okay, treasury stock, friends, is the difference. Forget about what's authorized, okay? That's just how many shares the company is allowed, if it wishes, to issue. And sometimes it doesn't issue everything that's been authorized. Sometimes it does. Okay, so treasury stock is the difference between what is issued and what is outstanding, okay? Only the shares in the trading public's hands, not counting the company itself, are considered outstanding. Those are the shares that get a dividend. Those are the shares that will vote. So all you have to do is take the issued minus the outstanding. The issued and the outstanding, okay? The number of issued shares is, what did I say, 3,800,000. Okay, the number of shares outstanding is 3,050. Okay, so the difference between those two must equal what the company themselves are holding, and that is called treasury stock. Ladies and gentlemen, it is that easy, okay? So we take the 3,800,000 minus the 3,050,000. The answer is 750 grand, okay? My computer froze for a minute there, I beg your pardon. All right, it's that easy. Let's go on and do problem number 2. Okay, problem number 2 says, a company called Carabine issues common stock. It also issues 50,000 of $7 preferred stock, and that stock is cumulative, okay? Preferred stock gives you a formula expressed either as a percentage of par or, as we see right here, a number of dollars per share. If a dividend is issued, and if it's sufficient, then a share of preferred stock is going to receive $7. Now, this company has 50,000 of them, so that means that preferred shareholders every single year are entitled to receive $350,000 if a dividend is declared. It may not be, or it might not be big enough to satisfy that $350. But it is cumulative, and that means that anything that is not paid, everything or a part of that $350, carries over in the next year, until the company can eliminate that obligation. Until it does, it never may. But until it does, the common shareholders get nothing. All right, what are we trying to do here? It says, I put a B there and there's no A, so I apologize for that. Okay? What we're trying to solve is how dividends will be distributed between preferred and common shareholders in each of these 5 years. Okay? I recommend you lay this problem, excuse me, that you lay this problem out exactly as we did in the text. Beg your pardon. Okay, so we start by listing what the actual dividend is. So I'm going to indicate the years that are involved here, and we're dealing with 5 years. They are, what did I say? I just put year 1. Okay, so year 1, 2, 3, 4, and 5. Okay, so those are going to be my years, all right? Okay, now we'll lay it out just like we did in the book. We're going to say the actual dividend, I'm going to say total dividend. Okay, down here I'm going to say to the preferred shareholders, SH, okay? I'm going to say if there's anything in arrears, anything that's owed to the preferred shareholders, either partial or total, how much is it? That's the amount that has to be satisfied that we have to carry over into future years until it can be paid and satisfied in full. Once that is done, then and only then can the common shareholders, SH, common shareholders, get something. Okay? The total dividend that I gave you all was 0 in this year. In year 2, 100,000, 500,000. Then in year 4, this company really starts to have some steroids, and they go up to a dividend of 1.4 million, and then 1.7 million in year 5. Okay, a little extreme, but again, this is for example only. Okay, how much do the preferred shareholders get every single year? I'm going to say preferred shareholders. I want to say due to preferred shareholders, just to differentiate. Not what they get, but what they're entitled to. Due to preferred shareholders. How's that? Okay, every single year, it's going to be 50,000 shares multiplied by $7 a share. There's the $3.50 they get every single year. I'm going to carry that right out for all 5 years. If the dividend is $350,000 every single year, it all goes to the preferred shareholders. There would be no arrearage at all. They're paid every year. But that's not what happens here. What's happening here, just checking my time here, is that they don't get anything in year 1. No dividend is declared at all. So the entire $350 is in arrears. That's going to be owed to them in the future. As of this year, they get nothing. And of course, the common shareholders get nothing. Okay, now what happens? Now, at the end of year 2, the preferred shareholders are still owed $350 for last year and $350 for this year, so they're owed a total of $700,000, right? The dividend of $100,000 is declared, and they get it all because they're owed $700,000 cumulatively, so that whole $100,000 goes to them. And since they're entitled to $700,000 and they get $100,000, an arrearage carries over of $600,000, and these poor souls again get nothing. Okay, now we go to year 3. We're still owing the preferred shareholders $600,000 as of the end of year 2, and now we're going to owe them another $350 for year 3. That's $950,000. The board declares a dividend of $500,000. Okay, $950 minus 500 means an arrearage is left of 450. Now we're chipping away at it, but it's not going yet. So once again, there is nothing left for these dudes down here. Okay, see how this works? I hope that's helpful to you. It's the same deal that we did in the text. All right, next we're going to go to year 4. Again, we owe them 450 from the end of year 3. And now we owe them another 350 for year 4. The total is $800,000. Okay, 800,000. All right, there's enough in this dividend to catch up all the arrearages and cover year 4 and have something left for the common shareholders. Therefore, there's not going to be any arrearage. We will wipe it all out. How much do the common shareholders get? Well, a dividend of $1,400,000 is declared. We owed the preferred shareholders $450, carried over from year 3, and we owe them $350 for year 4. So 1.4 million minus the 800,000 that completely catches us up leaves $600,000 for these folks here. All right, now here's where we really see the benefit of being a common shareholder. They take on more risk early on by letting the preferred shareholders step in front of them and cut the line for dividends. But the preferred shareholders are ceilinged at $350. So now there's no arrearage carried over from year 4. The board of directors declares a dividend of $1.7 million, $3 $350 has to go to the preferred shareholders. Okay, the common shareholders get $1.35 million and leave the preferred shareholders in the dust. That is the answer to problem number 2. Okay? So I'm just going to do my usual thing of highlighting that for you in yellow to show you that that is the solution. We also want to remember that the preferred shareholders are going to have to receive their $350 every year, and if it's not paid, it carries forward as an arrearage. The next problem I asked you to try was number what? Number 5, I guess. Okay, let's take a look at number 5 and see what we get. Number 5 says, Coca-Cola's price is $39.32. That's the closing market price. Their dividends per share are $1.22, $1.22, and their earnings per share are $1.87. Based on that information, what is their PE ratio and dividend yield? Okay. In my video lecture, I didn't focus on dividend yield, but I did mention it in one of my appendices lectures, the Appendix 4A, and it is in the text. Okay, so again, please remember my videos are not meant to replace the text, but only to emphasize. So you should have read this, but I'm going to walk you through the problem anyway. So please remember those numbers. Okay, they're all on page 86. Okay, so I'm asking you to find the price to earnings ratio. Okay, the price to earnings ratio is going to be defined as, at any point, the quotient of the stock price, which is 39.32, okay, divided by the earnings per share, which in this case I told you are $1.87. Okay, so if you math that out, 39.32 divided by 1.87, the answer is 21.03. Okay, it's that easy. So 39.32, 1.87, let me make sure I did that math right. I don't have a check number here. Yep, it looks right to me. Okay, that's the answer. Nice and easy. The second number I asked you to find was the dividend yield. Okay, the dividend yield is found by taking the dividends per share, which I told you are $1.22, and expressing them as a percentage of the current market price of the stock. So take $1.22 and divide it by 39.32, and let's see what we get. And of course, we're going to multiply that by 100 because we want that expressed as a percentage. So 1.22 divided by 39.32 times 100 is going to give us 3.10%. And that's our answer to the second part of question number 5. Okay? All right, we go look at problem number 6. All right, let's see what it says. Let me save this for you. All right, you're going to buy, this is a margin comparison, so we're going to compare buying on margin versus not buying on margin. Okay, so we're going to buy 1,000 shares of Pepsi at 80, and we are in a margin deal with our broker of 60%. That means 60% of our money can be used at our option. Now, if you have a margin arrangement, it doesn't mean you have to use it. In this case, we'll do it both ways. Okay, you are going to hold this stock for 2 months, then you're going to sell everything at 90. Okay, very good. That means you made a little money. Interest on your margin account is 2%. Forget about commissions and taxes. We'll keep this simple. I'll put commissions in the next problem. What's the net percentage return on the amount of money you yourself invested? Don't count the money advanced to you by your broker in a margin arrangement. They're loaning you the other 40%. Using those facts, what would happen if you invested it yourself, or, I'm sorry, first if you used margin, and then secondly, if you had not used margin. Okay, so let's lay it out just like we did in the text. So out here I'm going to put using cash and using margin. Okay. So we start an example like this by listing our gross profit. Okay. And using margin, that means that if you sell $90,000 worth of stock that you bought for $80,000, your gross profit is going to be $10,000. Okay, please remember you can scroll right over these formulas to see where I got my numbers from. Okay, then I'm going to put the amount of cash invested next. How much cash did you invest? If you used margin, then $80,000 of investment, you invested 60% of it. So to buy $80,000 worth of stock, it took $48,000 of your cash. The other $32,000 was advanced to you by the broker under your margin arrangement. Okay? Now we have to consider the amount of interest that was paid. Okay? Using margin, you're going to owe interest. And we know that the broker loaned you $32,000. Okay? We're going to multiply that by the annual interest rate, which I told you is 2%, and we're going to multiply that by the amount of time involved, 2 months out of 12, 2 divided by 12, since 2% is an annual rate, and that gives us $107 of interest. Okay, therefore, what is our net profit? The net profit is going to be our gross profit minus how much interest we had to pay as an additional cost of doing this transaction on a margin basis. Okay, lastly, I calculate my percent return, which is going to be how much money I yielded net profit-wise compared to how much money I myself invested. How much did I invest? I invested $48,000. So I'm going to take my $98.93 of net profit divided by my cash invested, and I want that as a percentage, so I'm going to multiply that by 100, and my answer is 20.6%. For 2 months of your money working, it's not a bad deal, is it, friends? All right, what's my gross profit if I use cash? Once again, it's going to be 90,000 minus 80,000. My gross sale price minus my gross purchase price. Okay, so in this case, my profit is the same. The amount of cash that I invested is my entire 80,000. I did not use margin. Interest, there won't be any interest if I don't use margin, of course. My net profit is the same, therefore, as my gross profit. Again, ignoring commissions. My percentage return, like before, is going to be $10,000 divided by how much money I invested times 100 to express it as a percentage. So there we see what using margin does for you. If I use my own cash, my yield was only 12.5%. If I use someone else's money, then the return on my own money is 20.6%. Okay, margin has worked in my favor. All right, problem number 7. Problem 7 says, okay, and I am going to stop there, friends, because I'm running out of time. More to come after.